battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are the Stenger Family Office. For the past 42 long years, it has been our mission to deliver both clarity and confidence to help secure your financial future. This is episode 124. Hard to believe. We are rolling right through August. School is back in session. Everybody's going back to school. The summer is winding down, unfortunately. And here in Chicago, we are about to be bracing for the cold winter. Hopefully not yet. Hopefully we got a couple more weeks till that sets in. But this is an exciting time of the year because we are getting very close to many of the events coming up right around the corner that we have been anticipating all year long, including September 7th with the legendary Dr. Jeremy Siegel from the Wharton School and Wisdom Tree Asset Management. Don't miss it. Live in person for our lunch Wealth Insights Forum, September 7th, 11:45 a.m. at Gibson's in Oak Brook. We will have a recording available as well if you're out of town and can't make it. So just ask us for that. We'll make it available. And then we also have a happy hour with our group in Houston in spring at the Marriott right across from ExxonMobil's headquarters. If you are Exxon, Chevron, Honeywell, BP, wherever you're from, if you're Shell, whatever company you're with, and you're in Houston and you're going to be around September 20th, I believe that's a Wednesday night, don't miss our happy hour. Can't wait to see it. It'll be a blast. And then the last thing on the calendar for the year, we will have some webinars in there that just haven't been released yet. But the last in-person thing for the year will be November 14th and 15th. That's our 2024 Investor Dates. We always call it the year ahead, so 2024. But it's really this year, September 14th and 15th, downtown Naperville at Hotel Indigo. And come into town if you have some time to take off work or want to make it in and get on the room block. Let us know. That is filling up quickly. You can stay at the hotel there, and then the next day, entire presentations at the hotel. So we've got a wonderful speaker, Justin Danoff with Strive Asset Management, who Sam Hardy and I just saw in New York City for the closing bell ceremony for a new product they had launched where they vote the proxies in line with American values, pro-excellence as they call it, as opposed to voting proxies from a political agenda. He'll be there for a presentation. And then also a wonderful speaker, one of First Trust's top speakers. They are an asset management firm in Wheaton who we have brought to you before. And I think you'll really like that presentation too. We'll have a wonderful time the 14th and 15th of November live in Naperville. So thank you for being with us today. Good Services Whiplash. And what we're really going to talk about, and when I started writing this article, this was before a lot of the big part of this most recent correction had happened. So I'll make a comment just before we start on this correction that we're living through right now. Then we'll jump in to the article specifically. And that's just to say that this is a normal part of being an equity owner. And I even wrote an article not too long ago that stocks can go higher. Yes, but the whole point was they can go higher over the long run, not in a straight line. And we never have that. We never have stocks go up in a straight line forever. At some point, you have to have some kind of a pullback. And most of the time, it's about a 5% pullback. That's roughly where we are today. Markets S&P 500 is trading around 4,300 points, just under 4,400 points. And the peak that we had this year so far was about 46. That's pretty normal. Now, I wouldn't be surprised if we get back even a couple hundred more points of that. Don't let that shock you either. We could see the S&P go down to right around 4,100, and that wouldn't be a surprise either. In fact, we had a correction like this. We have corrections like this all the time, 9 to 10% corrections in the stock market. So don't let that surprise you. Don't let that throw you off your plan and get all nervous and worried about the future of your portfolio. Here's an easy example. I just pulled up the chart. August of 2022, we were at 4,300 points. We dropped to 3,600, and that would have been a 16% intra-year pullback. We had another one, it's hard to believe, all the way back to February this year, but this did happen. Market was about 4,140 points, 4,140 in February of 2023, and then in March, about a month later, the market had dropped to 3870, which would have been, I'm going to do some real quick math here for you, would have been roughly a 6.5% pullback. So you see these happen all the time. This is not a reason to panic. In 2018, we had this. In 2016, 2015, even the best years in the stock market, even the years where we do post double-digit returns, we do have these pullbacks. And so don't let it toss you overboard. If you see a small correction intra-year, we could still end up double digits for the S&P. I still think that's in the cards, by the way. When you look at earnings, when you look at what's really going on, all the estimates are coming out and they're looking good. The third quarter earnings are looking pretty good. So I would not get bearish here. I would not panic. I would just stay on course. And it's surprising, but you may be shocked to hear this, but earnings estimates now for 2025, because remember, that's how we want to trade the market. We want to think about the future, not the past, or not even just what's happening right now, but really the future, because the market's a discounting mechanism that looks forward. Those earnings estimates for 2025 are already 1% higher than they were even a couple weeks ago, and that's a good sign. Now we're trading, we're looking at possibly an estimate of $275 in earnings on the S&P by the year 2025 at a 19 price to earnings ratio. That puts us around 5,225 points on the S&P, and on today's levels, that would be a 19% increase, not including dividends over the next couple years. And so if you actually annualize that out now, the next 2 years plus a dividend of roughly 1.75%, we are sitting well over double-digit returns for the next couple years. Do not panic. Don't lose your faith in U.S. stocks. Now, one thing that's important to note is we're going to start to see a timing effect of performance, which what I mean by that is we're going to start to see the all-time highs of COVID eventually flow through to the return numbers. So what I mean by that is if we look at the 5-year return on the S&P right now, remember that would put us back in 2018 when the market was under 3,000 points, if you can believe it. It was 2,000 to about 2,900 points. That means that the market today is roughly 50% higher than it was 5 years ago. What's ultimately going to start to occur as we go into the future just naturally is the return numbers are going to drop because it's going to start factoring in the all-time peaks of 2021. Now, just think about this operationally. In 3 years after 2021 puts us in 2024, really the end of 2024, and if the market's only about 5,000 points at the end of 2024, for example, that would basically mean that the S&P has only gone up 5% price return since the peak of 2021. And all that to say, that return number is not going to look very good. Even adding in a 1.75% dividend, the annualized return on the stock market by the end of 2024, in my estimation, is only going to be about 3.5%. That's what's happening, or that's what happens in history when you have 0% interest rates that go up to record high interest rates and get whipsawed all around. That's kind of the name of this episode, is Whiplash. And that's sort of the reality of what happens when you get into these higher interest rate environments. Be prepared, because a lot of the return you get in the market only comes from the dividend. And that's why we positioned you more towards dividends, so that you have gotten a return, that hopefully your only return hasn't just been price. And that's what happened with a lot of the growth investors. Something interesting, and this isn't a knock or anything against Kathy Wood. She's a very smart person. She's the person behind the ARK Innovation Fund, which looks at all these high-octane growth stocks. But eventually the return on that will look terrible. If you bought it in February of 2021, which a lot of people did, it was trading for $156 on the ETF, the exchange traded fund, and right now it's at 40. And so again, not a recommendation to buy or sell. We're not buying it, just to make that clear. But as a point, those return numbers are really going to start to look bad in a couple years. And because there's no dividend really on tech stocks for the most part, you could be, if you were a holder of that ETF or holder of high-octane tech stocks, you could be in for some chop and some zero return years for a long time. You'll get out of it eventually, like we did in the 90s and the tech bubble. But remember, back then it took about 20 years to break even on a lot of those top tech stocks. So that's where price comes into play. We've talked about this. So that's enough on the correction. Don't be surprised if we give a little bit more back the next couple months. That is typical, and I still expect we end up double digits return for the year. So let's jump in here. Goods, services, whiplash. When the lockdowns went into effect in 2020, the nature of consumer spending completely changed. And so there's basically two areas that we all spend money on. Just to make the economy really simple for a second, those two areas are goods and services. And it's stuff that you buy. It's like iPhones, for example, versus restaurants, going out to eat. A restaurant's a service. And so what we all did during COVID was, number one, we got locked into our houses. We couldn't go anywhere. And then number two, the government just blew cash in like it was going out of style, to the tune of 44% more dollars of increased money supply. Basically, people ended up with where maybe $100,000 in 2019 by the end of 2021 was now worth $140,000. That was the reality of COVID. So not only did you change the nature of how people were buying, but you also changed how much of it they could buy. And so you saw a lot of these companies. I would throw out some names like Peloton or Traeger. You remember the grills, the smokers, Pelotons, people were at home. And then, of course, the Traegers, where people were smoking meats that had never smoked meat before. Kind of a neat new hobby. But the reality is that spending went through the roof. And then obviously spending on services, transportation, getting in an Uber, going on a cruise ship, all of that really kind of fell off. What's happening now is the economy is doing the same two things in reverse. It's going back towards a services-oriented economy, and then at the same time, the money supply is starting to shrink just ever so slightly. People are running out of that excess cash that they had during COVID. Remember, if cash was worth $100,000 in 19, then $140,000 in 2021. Now it's back down to that kind of $100,000 level, maybe even closer to 90. And so purchasing power is down. And at the same time, people just aren't buying the stuff the same way. They're buying less Generac generators. They're buying less Pelotons. They're buying less Traegers. And they're going back to restaurants. They're going back to cruises. I heard like 5 people this week are taking cruises again, which the narrative during COVID, if you remember, was that nobody would take a cruise ever again. Well, we kind of said, no, don't worry. People will go back on cruise ships. Sure enough, here they are. So that spending on services is rebounding in a big way. And so because of that, you are having economic whiplash where companies like Peloton, Peloton was up 450% in 2020. And then in 2021, just a year later, it was down 77%. Today, it's trading for lower than its IPO price. And you saw this with Carvana and a number of these companies where they looked really good at first, but they're giving a lot back because of this goods, services whiplash. Now, there's another area we've had whiplash, and that's in the stimulus plans. President Trump spent about $4.7 trillion in stimulus, and Biden did the same, about $3.1 trillion. It's actually estimated that it's more than that, the true cost of the stimulus. That helped us tread water to an extent in 2022 and 2023, because remember, the government, from a philosophical standpoint, the government shut down our businesses, told us we couldn't go to work, told us that we couldn't do certain things, and so they had to compensate us for a lot of that mandated regulation. Well, they overcompensated. They blew way too much money. A lot of the COVID stimulus has actually been proven now to be fraud, and that's unfortunate. A lot of bad actors that got a hold of stimulus money. I also blame the government because they can't seem to keep track of trillions of dollars somehow. I don't know how this is possible, but they can't. They were sending people who had passed away in 2018 COVID checks. This is real. I mean, I had multiple clients who came in and said, my mother who passed a couple of years ago has a COVID check that just came in the mail. I don't know what to do with it. So that's kind of crazy. The point is now that liquidity is really, from a stimulus standpoint, drying up. It's not drying up as much as the federal funds rate has dried up liquidity. So remember, when the Fed does changes, they have two ways to kind of slow down inflation. One, they can raise the short-term interest rates. That's been the most dramatic shift we've seen. That's the biggest whiplash in the economy the past couple of years, that we have gone from 0% rates to 5% rates basically overnight. And now look at mortgage rates in the 8.5% zone. So that's really a big change. That's massive, massive whiplash. That's one of the things they can do. The other thing that they can do is they can start to basically expand their balance sheet or shrink their balance sheet depending on where they want to go. And that, combined with interest rates, has really provided quite a bit of whiplash in the economy. Now, what's happened, and a big part of, we're going to talk about this in a second, but what's happened is not only has higher interest rates and Federal Reserve action impacted the demand side, not only is it hurting demand, but it's also hurting supply. And remember, inflation is simply too many dollars chasing too few goods. And so if you have a whole lot of demand, not a lot of supply, prices are going to go up. Same thing is reversed. If you have a lot of supply and nobody wants your stuff, your prices are going to go down. When you have a 7% mortgage, not only do you hit pause and throw some cold water on the consumer looking for their house, but you also throw cold water on the builder who has to finance some of the expansion to build the new houses that we desperately need for consumers to buy. And so both sides of the equation have really, really impacted the housing market. Now, housing's unique because a lot of people are just not going to move on top of low inventory caused by a lack of building, a lack of just natural supply in the economy. I was looking at a chart from Lennar Corporation today. That's the company that Buffett just added to his portfolio. Not a recommendation to buy or sell, just telling you as an example. But Buffett looked at this Lennar Corporation that is building houses, and they even put in their presentation that after 08 and 09, there was regulation that came in. Some of it was good, but some of it was too much, and it just slowed down home building. So for 10, 12 years, thanks to the government getting involved, we have underbuilt housing. Now, you also have today a unique problem that nobody wants to move. And so that natural turnover is going to be much tougher. It's going to be much tougher for somebody to leave a 2.5% or 3.5% mortgage to go to something like a 7 or 8% mortgage unless they absolutely have to. So again, these are issues. I think housing is going to keep rising for a while. Maybe the initial 40% that we had during the COVID era is behind us, but there's still, in my belief, a lot more housing hikes to go. And so maybe if you're in a position to sell your house and you don't have to go buy something with a mortgage, that puts you in a better position. But for a lot of people in the housing market and millennials in general are really facing a tough time. And you're seeing the same thing with cars as well. So let's talk about CPI. This is really interesting, and you have to understand this because there's a difference between headline CPI, what the government reports is, hey, this is how much prices went up, versus the reality of what you and I really absorb as consumers, okay? So here's some easy ways to understand this. If you look at the breakdown of CPI, the components that make up that headline number, 32% of CPI is shelter, so that's housing. 14% is food, 13% is transportation, 7.5% is energy, and 7% is medical services. But here's the problem with that number. The average home price, the median home price sold in America today is $416,000. And if you go out and finance that house at current interest rates, you are paying roughly $3,000 per month to buy that house, and that would include some taxes and insurance. My numbers go off of the average, the average in the country. So right now, you're paying $3,000 a month for that house. That's not 32% of your budget. That's not 32% of median household income. Rather, that's 51% of median household income. In 2019, that median home price was in fact $325,000, and at a 4% interest rate, that monthly payment, instead of being $3,000 a month, was only $1,836 per month, quite a bit less. So that 2019 number did place housing at 32% of median household income at that time. That matched the CPI headline number. The problem today is it's not 32%. It's nowhere close to that. It's really, in my math here, about 51%. And that's why I think we actually are having more inflation underneath the surface than the government's reporting. And it's not a nefarious thing. I don't think it's something that they're trying to hide or anything like that. But I think it's instead just a factor of what people really pay. If you actually add it up and look at math, I don't think that CPI is taking into account true costs that people are incurring. Food costs are still up. Transport costs are still up. The only thing that's really down is energy. Energy's down about 50%, which has helped, but it's still up when you look at it over the past 5 years. And that's why I think there are some issues coming, and it could actually make the Fed raise rates higher than people think. You saw Bill Ackman come out and he shorted the 20-year, the 30-year Treasury. Why? Because he thinks rates are going to keep going up. I'm not totally out of that camp. Now, we don't short stuff over here. We're not believers in leverage and all that, but I actually tend to agree with his sentiment that rates have not stopped their climb, and you could continue to see rates go higher. That is not priced into the market. So just remember this, and this goes back to my original point that we could see some more pain in the market ahead. Don't be surprised or alarmed by this. Simply to say that right now, the market, I believe, is pricing in rate cuts, not just rates leveling off, but rate cuts by the year 2024, which is not that far away. I think that's kind of crazy. I don't think that you can possibly assume that Powell is going to cut rates that quickly. If he does, great. I think he should cut rates. I just don't think he's going to do it. I think he's going to keep rates higher for too long, and possibly even raise, especially if some of these numbers start really picking back up. You could see rates actually go higher than people are expecting. You're seeing the same thing in car prices. The average new car costs $48,000 in 2023 versus $37,000 in 2019. But at the same time, just like housing, interest rates are up. So the average car payment today is $716 a month. The share of Americans paying over $1,000 a month for a car payment is at a record high. And so that too is not fairly represented in headline inflation. And I think one of the problems that you will see, continued problems with goods, is that not all the pain has been felt by these good stocks either. If you bought a washing machine or a dryer in 2020, if you bought a new car in 2020 because you had some COVID cash, if you bought a Peloton or whatever it was, a Weber grill, anything you can imagine, you're probably not buying another one for a while. That could also kind of slow down some of these consumer-heavy goods-related stocks. And that's why we've always liked companies with a lot of operating leverage, and we've had you in some of the big tech names. Now, we cap it. We don't want to have too much in one of these companies, just from a risk management perspective. But I remember going back to a couple of rebalances ago, how some of the asset managers coming in would say, Nick, you got to get your people into all value stocks, all dividend, because big tech is just going to absolutely fall apart, meaning Apple, Amazon, Microsoft, they were all going to do terrible. And I said, well, maybe you're right in the short term, but from a fundamental standpoint, I disagreed with them because I said, look at their balance sheets, look at their earnings, look at how much cash they have, look at how well they're doing and how well their business models are poised to be successful. And you know, it turns out that was pretty much correct. Our sentiment there was right. And there was one quote that we had heard from Kevin O'Leary. He's the Shark Tank guy, but he also had a ETF company at the time who we were sort of following and watching. And so one of the quotes that he had said on a webinar was that value stocks are always a trade. And I think that's largely true. And it's not that every company that's value is a trade or that is a trap and you don't want to be in. But if you're only going after value, if you're only looking for companies just because they pay a high dividend and they don't necessarily have a whole lot of revenue or sales or a net income growth, then you could be into a trap, and that could be a trade. So that's why I've said stay high quality, stay in the best names. You look at all the different companies out there, and if there's 5 options, I am just a firm believer you want to own the highest quality one, even if you have to pay a little bit more for those earnings. So we aren't turning bearish on U.S. stocks, and I always like to say that at the end of these shows because what I'm trying to do is balance what we think is a short-term possible pullback coming, a short-term volatile environment against a long-run background that's actually highly positive. And so it all is going to come down to your risk tolerance, your goals. What are you trying to do in your financial plan? Are you going to be retiring in 2 years? Are you going to be retiring in 10 years? Are you retiring in 20 years? And so you got to have a goals-based approach, not a risk-based approach. If you have a risk-based approach, what you're doing is you're just worried about how much is the market going down. What you're not doing is you're not looking at what are my actual goals. Now, if you're going to retire in a couple years, we should build up a nice little treasury portfolio for you where we can get 5% risk-free interest and set that aside so you've got a nice buffer. But if you're going to retire in 5 years, even 4 or 5 years or more, I am a big believer in just hold on to stocks. If those numbers are right, which I think they will be, $275 in earnings on the S&P, that means the market, again, will trade 20% higher, giving you, with dividends, a 10% annualized return in the next couple years. So why would you panic out of that? Where else are you going to go and get 10% returns? And I know that's not a guarantee. I'm not saying that's a guarantee. These are obviously targets, and we have to do everything based off of math and research and statistics and all that. But if you look at the long run averages on the S&P, 10% has been the average for the past 10, 15 years. And so because of that, don't panic. Just stick with your stocks, stay on your plan, and have a goals-based plan that's allocating your dollars based on when you're going to need them. If you're retiring at 65, you're not going to need 90% of your portfolio for 30 years. You're going to need about 10 over the next couple. So have that real short term and real secure. Maybe another 5 if you're really, really conservative, and maybe another 5 on top of that if you're extra, extra conservative. But at least, in my opinion, in this kind of environment, you've got to have about 80% in the market. Now, there's all sorts of circumstances that can change that, so don't take that as individual advice. But that's just the reality. A bond will not save you, especially in a rising interest rate environment. So last thing I'll say, and this has really come up a lot in client meetings recently, is be careful not to confuse what the purpose of the different parts of your portfolio are. And what I mean by that is, let's say you do have an 80-20 portfolio, 80% being stocks, 20% being bonds. Let's say you have 70-30. Let's say you have 60-40. The stock part of the portfolio, very important to understand this, is your growth engine. The bond part of the portfolio is your risk management. Don't flip those on accident and go into the stock side and get ultra conservative, and then or vice versa, go into the bond side and get those bonds too aggressive. Because if you do that, you have screwed up the math on your portfolio, and the stocks won't be able to do well enough to make it through an entire market cycle and give you the returns you need. And then at the same time, the bonds won't be available there to protect you on the downside. So my point is, don't get those two things confused. Stocks are for the long run. Stocks are your growth engine. That's where you're supposed to get your long-term inflation-beating returns. On the bond side, that's supposed to be your security blanket. That's supposed to be a buffer for when times are bad. And there's no guarantees on either of those things I said, but that's the philosophy of how we run the portfolio. And as long as we don't get that goofed up, you'll be fine over the long run. You'll get the returns you need. You will beat inflation. And at some point, rates will come down. I just don't think they're coming down in 24. I'd welcome that. That'd be great if it happened. But my guess is it's going to be closer to 25 or 26. And so if you are in a pension plan and waiting to see what rates are going to do, that's my advice, is wait, give yourself a couple years here, let rates come down. I think they will come down. And same thing with stocks. If rates come down, not only will bonds do a little bit better, but so will stocks. Stocks will get revalued. And as long as we don't push stocks into the 24, 25 times earnings range for too long, we're okay. Right now, we're sitting at a forward of just under 20, right around 19 and a half times earnings. That's not a bad place to be. A little bit more expensive than it was the past 5 years. Not overly expensive, I think reasonably valued. And so that should give you some optimism to stick to your plan, stay the course, don't panic, and keep going for the long run. So that's all I've got for you for episode 124. Thanks for being on. We'll see you next week for episode 125. Thanks a lot.